Okay, please let me know when you can see the slide. Okay, all right, great. I take it that you can see the slide. So good afternoon, ladies and gentlemen. I welcome you all to this talk on financial management for retiring army officers. We are a SEBI-registered financial advisory, 360 Wealth Advice. We've been around for 2 years plus, and we focus primarily on armed forces officers and their financial management, but we also have corporate and corporate employees who are our clients, as well as some entrepreneurs. So let me, and before I start, this is a mandatory requirement. This presentation is not investment advice, and investment in securities markets is subject to market risk. Please do read all documents, anything related to your investment carefully before actually going in and investing. That being said, this talk is not just about investing, it is about financial management. As you all retire in the next couple of months, you would have a lot of concerns about, your retirement, your money, etc. And we had done a survey some time ago for retiring officers, and this is what we found. The biggest concerns are my savings adequate for retirement? Will I be able to fulfill commitments? How do I transition to the private sector, etc.? And to summarize, it's basically 32% of the people we found were fairly confident in their finances or the preparedness for retirement. The others were kind of not confident. Some of them were absolutely not sure. So we are trying to do something so that we clarify your mind on how to approach retirement, especially from the financial point. A little bit about myself. I'm also an army officer, retired army officer like you, took PMR in 2014. I've done all the typical appointments. Last appointment, I was Colonel JS 24 Div. Before being nominated for HDMC, I refused and I came out. I went to the US and did my MBA in the Fletcher School. And then in the last 10 or 11 years, I've been in the financial services world. I was in Muthoot FinCorp, then HSBC. And then now I am a SEBI registered financial advisor with our own company. We're right now at about 95 crores asset under management. So let's go forward. Now that we have started, so few housekeeping points. There is a chat button at the bottom right. So please click on it. And if you have any questions, just type it in, right? And we will cover all of your questions. So what happens is that we don't interrupt in between and we capture those questions, and you might find an answer coming somewhere down the line. So that's the reason why we do it like this. We will also have a question and answer session at the end, and we are recording this webinar. So, I will share the link of this webinar with you all. So you don't have to really take notes also. You just have to go through the link, watch the webinar again. All right, let's go forward. What will we discuss today? We'll look at these things, what is your retirement scenario like? And I'll look at a typical officer who's a colonel, 54 years old. There'll be a few changes for somebody who's a brigadier or major general, but typically the life state is a similar thing. Look at three main things. These are financial landmines. Liquidity trap, which is how to keep your money available for use versus locking it away, spending, and the third is insurance. And then we'll also look at a case study of a typical officer who's gone into re-employment. And, I've taken the re-employment case because it is peculiar. There's a second income coming, and there are certain implications on things like SCSS, which is Senior Citizen Savings Scheme, some things on taxation, etc. And we'll look at what you need to do from now to retirement. And of course, the last one will address all your questions. Whatever's on your mind, just keep noting it, putting it in the chat box, and we will answer it in the end. So where are you right now? What you see on this slide is, the age 50, 55, 60, and so on, till about 70. Maybe last year, a couple of 2-3 years ago, you might have bought a new car. A car costs about 10 to 30 lakhs today, depending on your choice. Your kids may be ready to go to college. Some of you would have kids who have already gone to college and looking for their PG, MBA, etc. And these are typical expenses. 20 lakhs is for a university in India, a private university which is not too expensive. 1 crore plus is if you want to send them abroad. and I can also share with you, my daughter's just gone abroad last week, and in the last 6 months itself, just because of the exchange rate changes, the amount that I had budgeted for it has jumped up by almost 10 to 12%. So this is the reality that we have to face when we are planning for a, and then another 5 years from the time that they finish their education, they will get married. Typically, today, armed forces officers between 20 to 35 lakhs is what you spend on weddings. And this is, I'm saying, all inclusive. There is no end to how much of gold you can give to your kids, and or how many people you can call. But this is what I'm showing is a reasonable number. There are, of course, exceptions where some people say we'll not spend more than 10 lakhs, or the others who say no, I will spend 50 lakhs or 70 lakhs. Those are exceptions. And then once you do all these things, you would have a little peace of mind, a little free from all these commitments. You'll say, let's go on a foreign trip if you've not done it. Or if you've done it in the past, you want to relive that, and you basically want to plan something like that. And typically it costs between 3 to 5 lakhs, 8 lakhs. You go to Thailand, it's about 1.5 lakhs for two people. If you go to Europe, it may be about 5, 6 lakhs, and so on. So this is where you are. And in terms of your income, you see, your salary is about to stop, and for most of us, we commute our pension, and therefore the pension amount for the next 15 years is going to be lower. So typically, for a colonel, after 50% commutation, the pension is around 1.2 lakhs, while the full pension may be 1.6 odd lakhs. Right? So it's a lower, reduced pension as compared to your salary, which was about 3.2, 3.3 lakhs. It has come down to this. So you've got to manage this. And then after 15 years, you will start getting full pension. But by that time, you're already 70 years plus. Right? So you really can't count on doing things at that time, because then you're old. Your kids are also maybe around 35, 40 years old. So this is in terms of your income. And then you have insurance on the other side. Right? So the day you retire, your AGIF insurance of 1 crore or 1.25 crore is finished, but you have extended AGIF available to you. And that is about 30 lakhs today, which lasts till you're 75 years of age. Right? It continues. And there are many people in the market who will tell you must take life insurance, you must do this, you must be covered till you're 80 years old. We will discuss that. You may not need that kind of insurance. It all depends on your commitments here. And then you have ECHS cover, which is health insurance. Again, there is a lot of conversation around buying private health insurance. ECHS is useless, and it doesn't treat you and all that. We will talk about this. There is a way to handle it. There are limitations in ECHS because it's a huge group insurance, and there's a lot of bureaucratic requirement, which is typical of any health insurance. What happens is, till we are in service, we never have to deal with the bureaucratic part of healthcare because it's all automatically done. Once we retire, ECHS being a health insurance policy and not the armed forces services insurance, a healthcare service. Therefore, the bureaucratic aspect has to be handled. So we look at these things, but this is where we are in terms of our life situation. So typically, what are the questions we have in mind as we retire? And these are, applicable to most of us. Most of these things are applicable. So my son will get married in 2 years, 3 years, or my daughter will get married. My daughter is going abroad, or my son is going to study. My car is now 8 years old. I want to replace it in the next 2 years. How do I take care of emergencies? And then you have, how much should I spend? Because suddenly from 3.2 lakhs, out of which you were saving maybe 70, 80,000 a month, to come down to 1.2 lakhs. How do we manage your monthly budget? If you have loans, what should you do with it? Home loan, a car loan. Very few people have this credit card outstanding, which is rare, but if you have it, you must close it off immediately. And then investment. Now, everybody feels this is the biggest part of it, but as you can see, out of these four, investment is only one small part of your, financial requirements. And it has many things within it also. But in financial requirements, there is another 4 things, which is retirement planning, insurance planning, tax, and estate planning. And in retirement planning, typically, you may find that 1.2 lakhs is not enough for you, because typically if one of your kids is still in school, 1.2 lakhs is not enough. So you need some additional income. How do you manage that? One is that you go and do re-employment, or you find a second job, or you find a way to invest so that you are able to get passive income. So that's something very important. Do you need additional insurance? Should you get more health insurance? How do I manage tax? Does after retirement my pension become tax free? Everybody's saying, below 12.75 lakhs, there is no tax. It's not as simple as that. It's a little, nuanced. So we must understand. And should I write a will? And this is very important because most of us have a will which we wrote, and deposited in AG's branch when we were commissioned. We wrote a one-liner that everything goes to my mother or father, and then we got married and we wrote everything goes to my wife, right? Now you have many assets, there are many responsibilities, so that one-liner will is no longer enough. And that one-liner will you will get back, I think, in that folder which you get when you retire. So you got to write your own will. It has to be fairly detailed so that if something happens to you, your family does not have to run around to try and get the legal thing done because there is no will or there is no nomination in your account, banking account, your investments, etc. So this, I've taken some time to explain this because each of these is important. We're going to cover some of it in the next, Now, let's look at what finances mean. See, financial planning means it's analysis of your current situation and look at what your financial goals are and how to get there. It's as simple as that. So, where are you today? This is one definition of it. It's these things that you see on the slide may not be applicable to all of you, but some of these would be applicable to each one of you. So, for example, see, currently your average income after tax would be about 21, 22 lakhs. It will reduce to about 14 lakhs, 13, 14 lakhs. Savings, you are able to do about 7, 8 lakhs, that will become zero. Unless you find a job which pays very well, that will not, then you may have any or all of these assets. You may have some of these liabilities, which are, the ones in red are your liabilities, housing loan or a car loan, or one of your child has gone to university, college, PG, etc. There might be some loan. And then on the other side, what are your goals? Right? These are assets and liabilities and income that work towards your goals. So what are these goals? Where should I invest? Now, where should I invest is not a goal. You see, that's like saying I have to go from Delhi to Bombay and my goal is to decide whether it is by air or train. By air or train is only means of transport. Your goal is to get to Bombay. Right? Similarly, where to invest is not a goal. Your goal is how much should I keep aside for emergencies? Should I go on foreign holidays and how much can I spend on it? Today, a car that I want costs 15 lakhs, but I have to replace it after 2 or 3 years. So how much will it cost at that time? Do I have that money, which will typically be 17, 18 lakhs? Do I have that kind of money? Or, children's college today, 20 lakhs, 30 lakhs. I have a son who's 12 years old. So another 6 years, he will go to college. So in 6 years, that same 20 lakhs will become something closer to 30 lakhs. So if today you plan for 20 lakhs, you must make sure that you invest in such a way that you are able to get 30 lakhs when he is 18, 17, 18 years old, and so on. So you have other commitments. And then you have liabilities. You must close your liabilities, especially, home loan, because you don't want to keep paying EMIs out of this 1,20,000. Or, you have invested it somewhere and from there you get pulling out money and paying EMI. It's better to close it off. So those are things that need discussion. Do you need life insurance? How do you manage ECHS? So these are on the right side, you see typical goals and requirement. On the left side is what you have got. And it is matching these two, which is financial planning. The big question that almost everybody has, to commute or not, there are calculations, that if you commute, you'll get 60 lakhs, and then you put it into this investment, it will give you 10%, and then you save tax and all of that. But the real thing, you see, those are calculations. The real thing is, what is the decision that you should take? What is it, whether commutation suits you or not? Once that decision is taken, and it has got nothing to do with those calculations, we'll just go through that. Then you can always calculate and work out what it is. So for example, people who have a gallantry award, right now, those who have disability no longer get that tax benefit, but those who have a gallantry award, they get a tax benefit. So it's a tax-free pension. if you get a tax-free pension, but you still need bulk money for a goal, right? Your daughter's going abroad, you need 70 lakhs. Abhi nahi hai. So chahiye, paisa chahiye. Then you must commute. There's no calculation. Then you need money, you don't have it, you have to commute. If you don't have any goals, you don't need, then you can say, I will not commute and I will continue to use it. However, you must remember that the benefit of commuting is that if something happens to you, you pass away, the remainder portion of that commutation is waived off and your wife will start getting your full pension. So commuting is like an insurance policy, right? As long as you utilize that commuted portion in a reasonable and good manner, you invest it or use it for what you need. For example, you see, when I took PMR, I got this commuted portion and I went abroad to study. I spent that money, right? So it was not a spend really, it was an investment. So you got to think about this. All right. On the other side, see, most of us, 90% or 95% of us are regular pension. We don't have that tax-free pension. We don't have a gallantry award. So we have a regular pension. Now what happens? You could either be re-employed or get a job. So if you're getting re-employment or getting a job, it means your requirement of monthly income is taken care of at least for the next 5 years. So you don't need that monthly income. So commute, take the money and invest it or spend it on whatever goal you have. Use it, right? And investing is also using it diligently. If you're not working after retirement, then what happens is you have this, you can commute and invest if you don't need that monthly income, right? You have some goals that are overriding, you commute it. If you have higher monthly expenses or you feel that, look, I will not be able to manage in this 1,20,000 or 30,000, then you can also commute partially. So you can see that, you see, in this decision matrix, the calculation of interest and income and tax and all that did not come. It is about your reality. Once you have decided and come to the conclusion, then you say, okay, now this has to be executed. So what is the taxation? Where do I invest? So for example, these two choices, commute and invest, where do I invest, right? Need bulk money, commute, you commute and use it. So that's the more important thing rather than just calculating those things. Your decision has to be based on your requirement. Let's look at liquidity. Now, this is the first landmine that we're going to discuss. This is for liquidity trap. See, what happens is when you retire, within 1 week, you will get your bulk money. You suddenly have one and a half crores in your bank. None of us have ever seen this bulk money in our lives because, on 31st, the pay comes and by 5th or 10th, the most of it is gone. So step one is, please put your money, shift it into a dumb bank account which does not have UPI, does not have any app. Keep it there till you figure out what you want to do. Because please understand, the moment the money comes in, there's an SMS that gets triggered. Your phone apps read all your SMSs. And those apps will convey this information to people who are then going to bombard you. It is not so much the bank or the thing. It is this whole ecosystem which will start bombarding you with scam things and you'll get caught in it. So best is put it in a dumb account so that even if you by mistake you click on a link or something, it is not connected to an account which can get scammed. Next, where do you invest? What are the options? Now, investments have 4 pillars. All investments. दुनिया में कोई भी चीज ले लो, there are 4 pillars. One is return, which everybody is excited about. कितना देती है? Right? 20% return. I want 30% return. I want 20% return. 5% is too less. 7 is return. Second is risk. That means if I put 1 lakh into this, next year will I get 1.2 lakhs or will I get 95,000? What is the probability of getting returns? How much can I lose? Uncertainty in that return. That is the risk. Or it could also be that, look, I invest in a company or bandi ho gaya. Therefore, be very careful about friends who will come and say, "Arey yaar, you invest 50 lakhs in my business. It is running fantastic. I'll give you 20% returns." If you don't understand that business, don't invest. And I'm going to show that to you. Liquidity. Liquidity is how quickly can you take that money out of that investment, irrespective of what's happening in the market. So, for example, if you have and I'll not jump the gun, I'll go there, right? Liquidity means ease with which you can take the money out into cash. And the last one is cost and tax. So nothing is free in this world. If you're putting it in the bank, you're getting a savings, account return of about 2.5, 3%. But if you had put it in FD, you would have got 5.5%. So you're losing 2, 3% by keeping it in savings account. If you keep it as cash, you're losing 6% on inflation. How? Because you see, for 100 rupees, you take 100 rupees note and go to a shop and say, I want a bottle, buy a bottle of Pepsi. He'll give it to you. After 1 year, you take that same note and go. He'll say, no, sir, अभी 100 rupees नहीं है, अभी 106 रुपए का हो गया. So just by keeping that money cash in your house, you lost 6%. So nothing is free. So you have to look at the cost of every investment, and then on top of that, understand what is the taxation. And taxation has to be managed. It's not something that is bad. The government needs money from you. You're earning. You have to pay. How you optimize it is what is important. I hope you all are also typing in your questions. Please, once more, if you have questions as we go forward, please open the chat box from that button on the bottom right and type in your questions, and we will address it towards the end. All right, so let's look at this, right? Take the first example, real estate. Returns, we don't know. द्वारका एक्सप्रेसवे में आएगा कि नहीं आएगा किसी को नहीं मालूम है. Because in 1995, the same thing happened for Greater Noida. There was AWHO coming, people said, yahi pe hone wala hai sab kuch, and people invested. But it took 25 years, and now the airport is coming, and now people are saying maybe the property price. So we don't know what the returns will be. Risk is medium, it is not low. Because, if you buy a property and you're not able to sell it, that's also a risk, because you can't get money when you want. The prices may go down. There are other risks, like the property may be owned by someone else. And recent Supreme Court judgments say that even if you have the registration, it is still not proof of ownership. So a lot of things happen. Be careful about buying excessive real estate. And I'm not saying don't buy real estate at all. Liquidity very low, because if you want to go and sell a flat or a house, you know how much time it takes. You cannot say, I will sell 1 bedroom and replace my car. You can't do that. Or you can't say, I will sell 1 bedroom of my I have 3 flats and I will sell, half a flat to send my son to university abroad. You can't do that. So that's the problem with liquidity and cost. Real estate, annual taxes, you have a tenant and they leave for 2 months, it's lying vacant. That's 2 months rent is cost, etc. And then of course taxation. So I just explained real estate, but you go on the other end and you see, for example, government schemes. Now this is a favorite. So let's take SCSS, Senior Citizen Savings Scheme, where you can put maximum of 30 lakhs into that scheme, and you will get every quarter, 8.2% return. So roughly every quarter you got about 62,000 rupees before tax. Now return, it is low because 8.2% is before tax. If you are re-employed or you have a job and you are in the 30% bracket, then 8.2% will become 4.8%. So the return is very, very low, especially if you're re-employed. If you're not re-employed, then it's a reasonable investment. Risk is very low. Government, there is no risk. Your money will not get lost. Liquidity, now SCSS, you see 5 years it's locked in. That 30 lakhs is, you can't touch it for the next 5 years. So liquidity is medium, low, right? Cost is very low. Government schemes by design, it's meant for middle class, ordinary people, so therefore the cost is low. However, the tax does come into play. So just look at all of these. These are some examples of investments that we typically do. Look at all of these. Every investment, you must look at these 4 pillars before deciding. Do not get carried away by promise of high returns, which is what typically everybody does. Hey, yaar, wo itna dega, baki sab bhul jate hain. Just please remember this. And the key thing is, once you've retired, your ability to recover from a serious mistake is very low because you're no longer earning. Right? If you lose 20, 30 lakhs on some friend's business who says, I will give you so much, and after 6 months, sorry, yaar, wo ho nahi paya. You can do nothing about it. But if you're serving, you're earning, then you could have still made it up. But now you can't. So just remember that. So return and liquidity, these are the two things that you must remember. Risk, of course, is there. It is the most important one. Let's go forward. Spending, that's the next minefield or the landmine that we encounter. You see, house, people or property. People say, I will buy, I have 1.4. Suddenly you feel like you have a lot of money. You see, yaar, wahan pe, I have a, for 60 lakhs, I'm getting a plot. So should I buy it? The thumb rule is, if your property, real estate is more than 40% of your total assets, don't buy more real estate. You're just locking in money and uncertainty, right? So 40-50% is zyada hai, so don't buy more. Don't buy it for investment. That's not a good idea. If you want, see, you don't have a property or you have a small one, you want to buy a larger flat to live in on retirement. That is fair. But you say, I will buy, I have two kids, मेरे पास एक ही घर है, तो मैं एक और खरीदूंगा, फिर वो दोनों को दूंगा. Those days are gone. Those days where when we all had ancestral property which was being divided, for most of us, ancestral property is all gone. We might have one odd small little thing here and there. So the whole concept of giving one property to each child, and those are slowly going up. If you try it, you may do it, but then you will not have liquidity. You will be tight on money. And just imagine, look at it this way, right? After 10 years from now, when you go to visit your kids, they may have a small baby. Do you want to gift them some money, or do you want to say, "Oh, sorry, मेरे पास वो property है, वही मैं दूंगा when I am done. Right now I have nothing. So please send me the air ticket money so that I can come to you." No, it's an extreme that I'm telling you, but the idea is don't. Second, car. Thumb rule, whatever car you buy, don't spend more than 10 to 15% of your financial assets, not your entire assets. So if your financial assets are about 1.5 crores, 10% is 15 lakhs to 20 lakhs. Reasonable. XUV 700, canteen mein milta hai. Reasonable. But if you say, I will buy a 35-40 lakh car, but my total financial assets are 1.5, it's a little, you're stretching it. You're going to feel that pinch somewhere else. The moment you exit the showroom, the car is down 15%. So also consider a second-hand car. I have been doing that, and I find it's a very good thing, because for a half the price, you will get a car that has much better quality. That is the reality. In 3 years, it's 60% down in price, or 50%, and you will get the same kind of quality. So that's something that you can consider. Weddings. You see, among my clients, I have people who, very few, who said, I will spend 1 crore on my daughter's wedding, and there are people who said, I have spent 10 lakhs. So there is nothing that is the absolute truth. There is no benchmark, but the benchmark you have to set for yourself in terms of what money you have, and how much you can afford. Because the wedding gets over in 2-3 days, that 30 lakh, 50 lakh will go away. It will just go away. But look at there's another way to look at it. You say, look, I have a budget of 25 lakhs for my son's wedding or my daughter's wedding. I can afford to do 50 lakhs, right? But I'm spending 25 lakhs, and the other 25 I will invest, so that when they're 40-45 years old, I'll gift them 1 crore. Do you think that's a better idea? So those are things that you need to consider. And then if you do all of these, house and car reasonable, and your wedding is planned, then you will have money to go abroad, take that holiday, 3-4 days. If you've never done it, this is the time to do it before you cross 60 and become too old, or just do it. You can do it. It's possible. So spending reasonable, right? Remember that. Then the last one, insurance confusion. There's a lot of confusion around it. I need more life insurance. People think that insurance will replace your income. It is not meant to replace your income. It is meant to protect your income for your family. Insurance is not meant for you. It is meant for those who are left behind. So right now, if your kids are teenagers or 20, 21 years old, yes, they are all left behind. 10 years from now, it is only your wife. Because your kids are 30 years old, they're no longer, they're not dependent on your income. So the first thing is, you see, life insurance is not meant to make your kids rich. It is just meant to protect whatever it is they are doing till they become independent and stable, or to protect your wife, right? Extended AGA for most people it is enough now. You see, take this case, if your son or daughter, the younger son is 17, 18 years old, he will need another 7, 8 years to become stable and find a job. That means around 22, 23 years के बाद में he is independent. Even if he's not independent and doesn't have a job, it is not your responsibility to take insurance, pay premium in retirement so that he gets 1.5, 2 crores if something happens. It's not meant for that, right? That you are got your assets to take care of it. This is meant only for that period when you're working, and if something happens, that income stops, and therefore your family needs it. Please remember on insurance, don't buy any ULIP money back policies. They will promise, they will not tell you this 3 to 4% return. This number they will not tell you. What they will tell you, sir, you pay 2 lakhs every year for the next 5 years, and after 15 years, we will give you 30 lakhs. The big number will, you will get impressed. But you see, as financial advisors, we do the calculation for all these policies. The bigger the number, the lower is the return. You will get about 3 to 4%, maybe 5% returns. You will feel good because you are getting that 30 lakhs after 15 years. But after 15 years, that 30 lakhs will have no value. It will have the same value as today's 12 lakhs. So please, thumb rule, do not take ULIP money back policies. They are of no use to you. That insurance cover is nothing. The returns is nothing. Please don't take it. Please invest it. Even if, better than this is you go and put it into one of these government schemes and just forget about it. No advance payment of premium. This is another thing. If you do take a term, even if you take a pure term policy, they will say, sir, up first 5 years में premium दे दो, उसके बाद जरूरत ही नहीं है. So you'll say, अरे fine, yeah, next 5 years I will pay. उसके बाद no premium. I'm covered till I'm 80. Firstly, you don't need insurance till you're 80. Why? Because when you're 70 years old or 80 years old, your kids will be 45, 50 years old. You think that they need your insurance money? They don't. So these are all gimmicks that have been created by insurance companies so that they can take your money upfront. They don't have to wait for 30 years, every year annual premium pay karega. Secondly, because your cover is up to 8 years old, your risk has become higher. Therefore, the premium you pay today in the next 5 years will also become higher. So please don't take any policy where there is firstly cover till you're 80. You should not take any insurance beyond 60 years of age. Secondly, do not pay any premium in advance. बोलो यार मेरा 10 साल अगर है कवर तो मैं हर साल प्रीमियम पे करूँ. Why? Because देखो 2 years I paid the premium, third year I died. Right? I will not be paying the premium for the next 7 years because I've died. But if I pay advance premium, तो मैंने पहले दे दिया 10 साल का. What's the point? Right? You have surplus money, it's okay, but no premium return policies. This is again another scam. They will say, sir, आप जो premium दे रहे हो, when you finish the policy, when you are 60 years old, 70, 80 years old, we will return all the premium. But to do this, they will double the premium that you're paying today. They will take double the normal premium and they will say we'll return after 30 years. And please, if you do the calculation again, it comes to 2% or 3% return. Please understand, insurance companies do not make money on a pure simple term policy where you pay premium every year. They can only make money by these gimmicks. These are 3 gimmicks. You will have money back, advance payment of premium, cover till you're 80 years old, and premium return. So please remember this. Okay, health insurance, ECH is good enough. There are many people, many veterans also who are insurance agents, and they will tell you, "यार बहुत खराब होता है, बहुत problem होती है." देखो, ECHS has its limitations. Those limitations are also there in health insurance, private health insurance companies. What you see on ad, that very nice hospital bed, and then people coming, it's not like that. On the last day when you are being discharged, they will not approve your claim. You will stay in that hospital from morning to evening waiting for that approval. And then when it comes, they will say, sir, bill total 12 lakhs ka hai, we approve only 8 lakhs. And it will happen in ECHS also. But please understand, like I said before, when we are in service, we go to a military hospital, get treated and come back. There is no paperwork. We don't sign anything. Because all of that is being done by the government for you. Once we retire, this ECHS is an insurance policy. Therefore, the paperwork has to be done. Otherwise, there will be scams people will scam the ECHS, and decent people who don't want to scam the organization like us will suffer. Therefore, they have put this bureaucratic thing. All insurance policies have this bureaucratic thing. For example, when you're taking the policy, you have to declare your illness. ECHS, you don't have to do it. You have any illness, it's all taken care of. When you go and get admitted, you have to inform. ECHS also you have to inform. Right? There are limitations in terms of, the expendables are not covered. The ECHS mein hota hai, expendables not covered, or this medicine is not there. Private health insurance also has got that. Only difference is private health insurance, you take a, this is where the example, right? So what 20 lakh cover, you'll pay a premium of 32,000. It is not a fixed premium like in life insurance. Every year the premium amount will increase. Therefore, please think hard. There are other ways to do it. You can keep aside a healthcare fund, 10 lakhs, 15 lakhs, depending on your level of, comfort. Invest it, keep it there. When you get admitted in hospital, ECHS says, यार 10 लाख में से मैं हम 9 ही देंगे, तो आप 1 लाख जो balance बच गया, you take it out of this fund and pay it. You really don't need a separate private health insurance policy. Okay, let's go forward. Let's look at a case study. This is a typical officer, he's a colonel, and this is, I've anonymized the profile of one of our clients. So you can see gross salary in re-employment, roughly it's about 2,15,000. And then you have pension, which gets reduced because you're getting that salary. So 250,000. Typically, this is what it is. And this officer has a rental, he has a small flat. So this is the income that he's getting, right? These are typical expenses. Why am I showing you this? I'm showing you this because this is the level of detail that we go into when we make plans. You may not do it. You can at least consider these things. These are realities that you must consider when you're planning for or considering things for yourself. So these are, you see, income tax dena hai because there is this salary here. Home loan, this person has a home loan that is continuing, so 25,000. Either you pay off the complete loan or you continue to pay the EMI. You have to manage that. He has a health insurance which is due on renewal in May. So we had suggested to him that please close it. It is of no use. The premium was 40,000 rupees. You have ECHS and then you have this. It's double. So this is the income. Then you have, these typical expenses here. And these are all essential living expenses. So he has this life insurance premium, but there are many people who want to give for charity. His daughter is living in another city and studying somewhere, so they need that support. Son's college fees there, some discretionary expenses. These are all realities, and so for this person, the expenses are about 234. But a typical retired officer who's not working, you cannot manage in this kind of an income. You have to adjust your expenses because firstly, tax will be zero probably. Other things you have to adjust to get it down, and that is an important part of retirement planning. That was income and expenses. This is assets and liabilities. On the left side on red you can see liabilities. Liability is loan, so 15 lakh you have to repay. That's a liability. And typical assets, right? There's a flat, there are 2 cars, some mutual funds, and then you see, so we'll come to that, and then some life insurance policy, right? And this is like a money back endowment policy which will mature in 3-4 years from now. At that time you add it to the mutual funds as long-term investment. But also coming back, you see, many people invest in their wife's name even if she doesn't have an income, thinking that you will save tax. Please understand that taxation rules are clear. Capital gains on investments are taxed based on who earned that money, not whose account it is gaining that, that capital gain. So if you gift money to your wife and she invests, she gets capital gains, you have to pay the tax. The income tax department may not say anything for 5 years, but they will come back after that and say you have not paid the tax on this one, and the penalty is so much, 2% per month, and you have to pay the whole thing. So at that time, you will have to pull out money from your investment to pay this, because you can't escape the income tax department. These ideas are, you see, these kind of things are given by so-called CAs who say, sir, मैं आपको इतना refund करा दूंगा. Those are not really CAs. And so please be aware of this, right? Investing in your spouse's name doesn't help you. If your child is grown up, you can gift that child and invest in their name. But then that money goes, it is with them. It is about managing control versus returns, right? So you say, I will give 70 lakhs to my son and it will invest in his name, tax bach jayega. But after 5 years, he will start a job and then he is also taxable. Then what do you do? Then that money is in his name, right? So please be careful and consider all these things. This one, like I mentioned, right? Endowment policy. He has a housing loan. He was paying that EMI, so 15 lakhs is there. So as part of your planning, default is try to finish off your loans when you're retiring. Don't keep anything pending because then that monthly thing will keep going. Your pension has come down. It's better that just pay it off because you know housing loan typically about 9% hota hai. If you are in the last few years of your loan, then you can continue with it also. Because in the last few years, the EMI may you're only repaying the principal amount. Therefore, whether you close it or not, it doesn't matter. But if you're somewhere in the middle of your loan, you must try and close it off. That's a thumb rule. And then you continue with the case study, right? So we looked at income, expenses, and assets and liabilities. Now we look at goals. You see this long list of financial goals. These are typical goals. Most of you will have some combination of this. And for each goal, we worked out what is the expense today, by when do you need it, how much will it cost you at that time. And please look at this, right? Son's college inflation for education is not 6%, it is 9%. Or even people are now saying it's 10%. If you're planning to send your kids abroad, it is 11-12% because of the exchange rate. So there is one is, you see in the US, I went to the US and studied, so there the typical inflation in college, university fees about 5%. So 5%, add another 3 to 4% of your exchange rate, so 9% wahin pe ho gaya. Then there are special years like 25, 26 when the exchange rate has just gone through the roof. So we factor in those things in final expense. Then you say, where do you invest? Which is the most suited, tool to invest in? How much is to be invested initially? And then how do you manage it? This is a typical plan that we make for our thing. You should also just put it, even if you just write it on a piece of paper and just say, yeah, मेरे को ये चाहिए, इतने पैसे चाहिए होंगे, yeah, that is good. But if you want something professional, we are always there to help you. But look at this, right? We talked about health insurance. So here we have this officer, he has a healthcare fund of 10 lakhs. So what happens is this fund is sitting there. How many times do you think you or your wife will go to hospital and get admitted in 10 years? Maybe once, kind rarely hota hai, first 10 years at least, later on maybe. You get admitted, typically the hospital bill, statistically 80% of bills are below 5 lakhs. We are older people, therefore let's say 10 lakhs, right? So अगर 9 lakhs का बिल आया उसमें से ECHS ने 8 lakhs दे दिया, 1 lakh is remaining, pay out of this healthcare fund. And this healthcare fund is not static 10 lakhs, it is also growing, right? It is put in arbitrage and it's growing at 6%. It's growing at the time. So as long as you don't use it, it's growing. At one point you need money, you take out and pay. That's better than doing a health insurance and paying that huge premium, and then going for claim and they'll tell you the same story. कि पूरा नहीं मिलेगा. All right. So then, yes, passive income. So this officer, you see, December 29. So this officer has gone for re-employment after 4 years. When re-employment ends, you come back to that normal pension, which is 120. So this officer felt he needed more money. So we planned for a passive income from that year. And in 75,000 today becomes almost 1 lakh 4 years from now, right? And so we said, okay, this is how much you need to invest. And so that you are able to do it, get that passive income for 5, 7, 10 years till your pension becomes normalized. Let's go forward. And this is the last slide on the case study. You see, what till now in this, we have not talked about where to invest, right? What instruments to invest in. So before that, we do a risk assessment. So we did a risk assessment for this officer. He has moderately conservative profile. That means you can't take too many risks. You saw he has got a loan, he's got his kid is going to college, so many commitments are there. You can't take risk. So moderately conservative, which means we identified that he should not have more than 30 to 40% in equity, the rest is in debt. This is the composition of the investment of his portfolio. And then we said, okay, for each goal, where do we invest? So, for example, there's medium term goals, there are three of them. These are hybrid funds and arbitrage. There's no equity in it. Then you have long term goal. This is long term goal, right? It is 7 years and beyond. We have, you see, 30, 10, 20. So, sorry, 30 and 10, 40% is equity. Then you have debt. Then you have some dynamic, so this is a combination of debt. What almost 50% is debt and 10% goal. So this is how, so last step is kahan invest karna hai, after considering all of these. But what everybody says is, I got 1.5 crores, kahan dalu isko? Where will I get 20% or where will I get 15%? That is just investing for the sake of investing. But to reach your financial goals, you have to go, just think through, and then you say, okay, I need some money in 3 years, where do I put it? I need after 5 years, after 10 years, where to put it? Can I afford all of these? Is holiday a priority or sending my son to college? So then you say, yaar, dono nahi ho sakta, to फिर obviously I'll send my son to college. Holiday I'll do later. Maybe we'll see after 5 years. Right? So you have to prioritize your goals. So that's how it goes. What do we do from now to retirement? This is for all of us, right? Assess your current financial status. How much will you get? What else do you have? Assess it. Organize all your accounts. You have 3-4 accounts. Try to consolidate into two. Get it into shape. Bank accounts, your investments. Shift your benefits into dumb account when you get your money. Remember this. And I have a client. She's a civilian lady. Single lady. She had the bulk money, about 70-80 lakhs coming in maturity of an insurance policy which she had taken. And that money came in. She immediately got these messages and she reached out to me that I want some financial advice and all that. So I talked to her. Same day, she got this message on her phone that, look, you invest and we will give you 20% returns. She said, yaar, ye zyada acha hai, because this guy was saying, I will do all this financial planning. Ye keh raha hai, mujhe 20% milega. She clicked on the link. She lost that 80 lakh rupees. And then after 3 months, she contacted me again saying that this happened. That's why I didn't know what to do. But now there's a police case, all this is happening. My accounts are frozen. And so now it is almost 1 year after that and we have got her back on track. But don't go there, right? Take care of your money. Plan to close loans. Unless you have the money to pay your EMIs and all that. You have surplus monthly income, that's fine. Document preparation is okay. How to fund immediate financial goals? Do that first before spending. पता है कि मेरी कार 7-8 साल पुरानी है, so first I'll buy a 40 lakh का कार. बहुत दिनों से शौक था यार. Please take stock of your requirements, then only go in. Relocation and housing, this is important. Typically people move from their last posting station to their home station. Some people say my house is in Bareilly, but I have to go and live in Gurgaon for 3 years because my son is studying there. You don't have to go and buy a flat just because you're living there. Take a house on rent. Typically, the cost of renting is much lower than buying. Wherever you go. See, a 3 crore flat in Bangalore is available for about 50,000 rent. 50,000 rent is about 6 lakhs a year, right? Now, 6 lakhs means 6 lakhs on 3 crores is how much? It is about less than 2%. Or you can go and buy a 3 crore flat, to live in for 3-4 years. That doesn't. Re-employment, career planning, do all this. It's not really financial advice, but then yes, relocation, I've covered it. And legal and estate, this is very important. Please try to do it within 3 months of retiring. Document it. Check all your nominations in all your accounts, bank, investment, mutual fund. And remember, most important, your nomination should be aligned with what you write in the will. So for example, in the nomination, you say 50% to daughter and 50 to wife. And then in your will, you write everything goes to my wife. So something happens to you. You see, the fastest way to transfer your investment is, say, your nominee hai, please transfer as per nominee. They will do it. But if your nominee and will are misaligned, the person in the will, if it is a third party, then they will come and say, third party means, you've given something to your daughter and your son says, मेरे will में तो ये लिखा हुआ है, वो हो जाएगा. So please make sure your nominations and your will are absolutely aligned. What are the options for support? This is important. As you go forward, you will get lots of phone calls, messages. People will call you, हमारे साथ आ जाओ, हमारे साथ करो. These are the choices. You have mutual fund distributors who will give you mutual fund investment. They are not SEBI authorized. They are distributors or people who sell mutual funds, right? And they are regular mutual funds. Typically, commission you will find about 1%. So what is 1% small amount? On 1 crore, it is 1 lakh every year. It is not a one-time commission, it is every year. And as your portfolio grows, that commission, that 1% will also correspondingly grow. Second one is bank relationship managers. They're in the bank. Moment money come, they will come and say, "Sir, ye ULIP le lo, aap ye insurance policy le lo. I will give you a very nice credit card, the HDFC in Pinyas or unlimited launch access." All that they will tell you. But there is a cost to pay because they will push stuff where they have maximum commission and incentive. And the last one is SEBI registered like me. Now, what we do is SEBI authorized. I get fee from my client. I don't get commission from anywhere else. So if I get fee from my client, I'll work in their interest. And there is a fee. It's nothing for free. But we have a fee structure that is much better than for mutual fund distributors who in any case come with much lesser capability. And so we have these charges. Let's go forward. What are some best practices? This is my last slide. Assets. Don't buy more property for investment and lock in large amounts, right? Avoid anything which is a long lock-in like ULIP or money back policy, endowment policy. These are all not meant for investment, not meant for insurance. Ask about commission and cost for everything. So when somebody says, "Sir, yeah, aap le lo, bahut acha bolna," you tell me how much commission will you get, and he will say 0.3, 0.8. No, please tell me exact amount on this X investment of mine. If he is a commission agent, he will not tell you, because if he tells you, you will not take it. Okay, liabilities. Please avoid loans and EMIs after retirement. Avoid. I'm not saying just don't take. There are some people who have that requirement and commitment, but keep minimized. Education loan for your kids is okay. If you are able to pay it comfortably, it's fine. If you're not able to, please make your kids responsible for part of it. They can repay when they get a job. And another thing, this is not financial advice, but please don't spend money on some education which has a good thapa. Foreign education hai, the university is not known to anyone, but they will say, "Sir, please," somebody will come and say, "Sir, please, bas apply kar do. There is no requirement of any test and all. We'll give you admission." Please don't go there. You spend 40, 50 lakhs, your son or daughter will come back from there and not get a job. And I'm saying this because I myself gone abroad and studied. My daughter's gone abroad now. And the only condition that I gave to my daughter was, if you're going to the best place in the world to study, I will send you. If it is anything other than that, sorry, I don't have the money. Right? Because if you send them, it is basically a way of transferring your wealth, which you built over 30, 40 years of service life, to some university, and your kids will not also benefit. Income manage within rent, then buy property. Don't take SCSs if you plan to get reemployed. Thumb rule, if you're getting reemployed, don't take SCSs. Or if you're getting a job, you're certain that you'll get a job, right? Don't take SCSs because considering the return and the tax, it is not beneficial and there is a lock-in. I'm not saying SCSs is bad. Please understand the government has created this kind of scheme. It is best suited for JCOs, NCOs who retire, because they are not in the tax bracket. They will get this safe 30 lakh invested, and for 5 years they will get 62,000 every quarter. So it's meant for them. It is not meant for those who will get reemployed and get a second job. Large spend only after planning for everything. Please don't buy anything you can't replace. So you get 1.5 or 2 crores because you got more in your DSOP. You'll go and buy a Mercedes for 60 lakhs. That is fine, but after 10 years, can you replace it with another Mercedes? If you can't, please don't buy it. If you have accounts like PPF, we said tax advantage, you already invested and got some money, please don't close it, continue with it, because it is a very safe government guaranteed investment, gives you 7.1% tax free, but this is only if you already got it. You can't start opening a PPF account now. It will not benefit you anymore. Don't sell and buy financial assets frequently. मैंने यहाँ से trade कर दिया वो कर दिया. Don't go into trading, uh, futures and options. They don't make money. Please remember this. 99% of people who trade will lose, and that 1% people sitting in Mumbai will earn and gain. That is how the algorithms work and the whole system works. You may make a few lucky breaks here and there, and that is exactly how gambling works. And then protection, don't take a money back policy. Check if your dependents need term insurance. If thumb rule, if your son and daughter kids are 20 years plus, you don't take any other insurance. If your kids are 10 or 11, yes, maybe you need to take. Plan for health and long-term expenses, estate nomination हो गया. Please don't invest on tips, WhatsApp messages, WhatsApp groups. बहुत ज्ञानी लोग होते हैं. Please don't do that, because while you are serving, you make a mistake, you can correct it because you continue to earn. Today, if you make a mistake, if you make, even if it's for 10 lakhs, 15 lakhs, it's gone, is gone. What next? I'm recording this webinar, so I will share the link with you through MP5. Major Bishop will help us with that. There is on my website, there is a page where you have this comprehensive guide to finances in retirement, how to select an investment advisor. And that website also has a number of blog posts on all these things: SCSS, EPF, PPF, SIF, trading, and it's specifically for retiring officers and retired officers. So please go through it when you have the time. You might find something useful there. This is my last slide. I am open to questions now. And let me just see on the chat box. We'll start from there. And please add your messages, questions on chat. Okay. So there are no questions there at the moment. Okay. Yeah. Okay. So I see one message there. Amar, so why term insurance for 20 plus kids is not required? You said it. Take it if the kids are 10 to 11 years. Okay. Now let me explain life insurance once again. You see, life insurance is not to make anyone rich in your family. It is that you have a salaried income coming in, and if you pass away, that income will stop. So this insurance policy is meant to replace that income. That is why AGIF also gives you 1.25 crores of life insurance till you're serving, because till you're serving, you have an income. If that stops, your family gets affected. Now, what is the definition of a family? They are dependents. If your son and daughter are 21 years old, reasonably in another 2-3 years, they should become independent. They should start working. They have to find their way. But your wife, she is an older person. She needs support. But for that, you have your assets. You have your retirement benefits. She gets a family pension. Therefore, she doesn't need insurance. And as people who are retiring and older, and we have kids, our responsibility is not to keep providing for our kids even when they're in their 20s and 30s. Did our parents do that? Could they afford it? No. So therefore, should you take a policy and keep paying premium in your retirement? That is the thing. So if your kids are younger, you see, you're 55 years old and you're married late, your kids are 12 years old. So that means they will take another 10 years to become independent. Independent doesn't mean that till they have a 2 lakh salary. It means that they are finished their college and they should find a job. वो चाहे स्विगी राइडर बनता है या CEO बनता है, वो उसके ऊपर है. I know that as parents we all feel bad, but then there are certain things which are the realities of life. So if the kid is 12 years old, you definitely want to make sure that the next 10-12 years till they go through college, you are safe. Therefore, you can take a policy for 10 years. Premiums will be high because you're 54, 55, but you can take a policy if you feel, but it needs a little deliberate planning. Next question is, just go through it one by one. Thanks for the estimate of Thailand trip. Yes, we went last year. So, okay, what's more important, to finish off the loans or to invest? If loans are liquidated, there is nothing left to invest. Okay, good question. That's a good question. So, won't it be better to invest first, let it grow, and then pay off the loans, or should it be 50? Okay, let's look at it this way. Look, there are different types of loans. Car loan, right? Car is a depreciating asset. Uski value kam hoti ja rahi hai. So if your car is 3-4 years, 5 years old, and you have a remaining, residual loan value of 3-4 lakhs, pay it off and pension, because uska interest rate, it may be on the higher side. Home loan. Now, home loan is a little different. See, typically home loans are 15, 20 years duration. If you're in the first half of that duration, that means you've taken the loan only about 5, 7, 10 years ago. What happens is in the initial period of the home loan, your EMI is made up of interest, more interest and less of the principal. So in the first half of the loan, first half of the period of the loan, you are basically paying all the interest. आपका principal कम नहीं हुआ है. So if you want to really reduce the loan commitment quickly, you prepay. So when you prepay, what happens is only your principal part comes down, so interest will also come down. In the second half of the loan, what happens is that your EMI is made up of more principal and less interest. So if you prepay, now what happens if you prepay, as it is you're paying off your principal amount every month. Now by prepaying, you only made a difference to this part. So whether you prepay or you keep paying, in the last 2-3 years especially, you're basically only repaying the principal part. So jaldi doge या महीने में दोगे एक ही बात है, right? So therefore, home loan is a little different. Credit card, if you have an outstanding that goes beyond 1 month, you should not have it because credit card interest rate is 36 to 45%. So there are very few army officers, armed forces officers who have credit card, but if you have that habit of spilling over to the next month, card the credit card go and give it away because that 45% interest is criminal. So these are the three main loans. I hope I have covered that. Okay, then there's somebody says I'm 60 and over with liabilities. Do you recommend a larger percentage investment in equity mutual fund? Okay, this is a good question again. See, equity is risk. It has higher risk. I'm not saying it is bad or it is risky. It has higher risk. What is risk? Risk is that in the next 2 to 3 years or 5 years, you may not get any returns on it. So therefore, where you invest does not depend on your age so much, but on your commitment, and therefore from there flows your risk profile. So, whether you have, how many dependents do you have, your kids are independent or not, how much money assets do you have any loans, right? Do you have any parents who are dependents? Typically, if parents are dependent means you have to take care of their health. It is a big expense. So if you have all those things, you cannot take risk with your money. Therefore, you would invest lesser in equity, more in the other safer instrument. But there may be some other person, no, you see, my father has given me so much property and I didn't have to spend too much when I was serving. So I've got 2.5, 3 crores as part of my retirement benefit. My kids are already working. There is no, you see, this person can take more risk. Risk means they can invest more and wait for a longer time. It doesn't affect them. Therefore, they can invest more in equity. So it depends from person to person, depending on what kind of commitments and what have you got to lose. If you got more to lose, you cannot lose more by investing in equity or the chance of losing. I'm not saying equity you lose, you also make gains. How much will be the effective yield in SCSS after IT, the interest after excluding income tax for retiring brigadier? Okay, so good question. See, retiring brigadier or colonel are, if you are not taking re-employment, your pension will be about 1,20,000, 130. So typically, you may have a little bit of a tax. Maybe you'll be in the 10% bracket or maybe in the 15% bracket. Now, SCSS 30 lakhs if you invest, the quarterly payout is 62,000 something, right? 8.2% interest, you will get 62,000. Out of that, the tax you have to pay. So if you are in the 15% tax bracket, you will pay something like, that 62,000 is full interest. Okay. So the whole thing is taxed. So out of that, if you're in the 10% bracket, 6,000 will go. Remaining, which is about 56,000, you will get every quarter, right? These are approximately, will be little either udhar hoga, 500 rupees upar niche hoga, but generally I've done this calculation, so I remember the numbers. So effectively what happens is the 8.2% minus the 10 or 15% tax, right? So 8.2 minus 0.82 or minus 1.2. It comes to about 7% straight away. If you are re-employed, you are in the 30% bracket. That means 8.2 minus 2.4. It comes to about 5.7, 5.8% return. 5.8% is less than inflation. So why would you lock in 30 lakh rupees in an investment that gives you 5.8%, and when you don't need the quarterly income also, because you're employed, you're getting salary? That is the logic. Okay, home loan currently 7.1%. If one is opting for it, does it make sense to liquidate? This is inadequate information to give. This is a very specific thing, but I just covered it in. So there is a thumb rule. I mean, there's a logic to be applied, so we can do that. Maybe we can connect separately, and I have a gallantry award. Shall I go for SCSS? So again, let me go back to that slide. You see, there you go. Right? I hope you can see the slide. So you have a tax-free pension. Do you need bulk money? If you do, then you commute. If you don't need, you invest monthly or spend. Now, SCSS. If you have a tax-free pension and you commute, what will be your monthly pension? Roughly around 1,20,25,000, because 110 and plus the tax which otherwise goes away, 125,000. If 125 is not enough, then you do SCSS. So it has got no relationship with the gallantry award, right? It has a relationship with whether you are re-employed or you have a job, and then whether you need money. So I hope I'm able to explain that, right? Next question, should an additional real estate held be sold to clear off home loan or pay the EMI of the home loan, keep real estate on rent? Again, good question. So look, real estate, see, it depends. Now there's so many things in it. That real estate, how old is it? Have you got a good return? Has it grown in value? Does it make sense to sell it? If you sell it, what will be the capital gains tax on that sale? So if there is capital gains after paying it, what is the return that you're getting on that sale? And then from there you will pay off the EMI, home loan, right? So it is a interrelated thing. So your start point is an existing property where it started from, and then end point is a home loan where you're paying EMI and there is a residual repayment value. So these are there. Okay, reverse mortgage. Your views on reverse mortgage? So reverse mortgage is, you see, it's meant for people who do not have any assets other than a real estate. Typically they don't have an income. So and typically people work in private sectors who don't have pension, but they managed to build one property. Now अब उस घर में रह सकते हैं लेकिन इनकम नहीं है तो जिएंगे कैसे? So reverse mortgage is created for that. Right? 25 years or so or 30 years, you basically put it on reverse mortgage. Every month, basically, they are giving you an EMI on that property, right? And that EMI is a fixed amount. I think it can be variable also. It will last for that 25 years. After that, the bank will tell your kids or whoever is remaining, that look, do you want to buy this, pay and take this property back, or do you want to let it go? So if you say if your kids say let it go, then the bank will take possession of that property, but you are no longer there, right? And so that's the calculation. All right, so that was the last question, and I think Major Bisht is there and he wants me to close it.